Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 55. On today's episode, we're going to go over Wall Street scandals. What are some of the biggest scandals that have rocked the market over the past 20 years, and how have they impacted legislation? What are some things that are now in place to try to help protect you as an investor? And how can you use the lessons of those financial scandals as you evaluate and look for companies to invest in? So I don't even know if we'll be able to get through all of them. We might have to do a two-parter on this one, but we thought it'd be interesting to cover these. So get your mind right. Let's get to work. All right. Well, welcome back to the show, everybody. I appreciate you listening as always. So thought it would be fun to cover financial scandals that have rocked Wall Street over just the past 20 years. I mean, we don't even have the time to go back further than that. But just looking at some that have happened since 1999 to today, and there's plenty of them. And I think it's important to cover these because, when you're thinking about and analyzing companies, thinking about this, when I think about all the scandals, I always think about there's always some going on. They just haven't been uncovered yet. And so, when you think about things in that terms, because we're going to go over Enron, we'll go over Bernie Madoff, some of the big ones out there. I feel like there's always going to be companies that are trying to game the system. There's always going to be financial advisors that are trying to game clients. Any industry where you can make a lot of money, there's going to be people who have bad intentions, unfortunately. That's just the way that it works. So you see everything going on with crypto, Three Arrows Capital. And so it's very pertinent in today's world because you're going to notice that a lot of times with some of these, they don't get caught until market turbulence kind of exposes them. So this is Warren Buffett says that you never know who's swimming naked until the tide goes out, right? And so when things are going well, everybody's doing well, but when the market starts to get rocky, people who have, used leverage or they borrowed too much money, it gets them. And then you start seeing others that are dragged down because of that. So we'll cover kind of what's happening in the crypto space because that's definitely going on. But, history doesn't repeat itself, but it does rhyme. And so, some of these scandals, could they have been avoided? Maybe. Possibly. I mean, there's laws that are in place now to try to prevent them from happening, but it's always a cat and mouse game, right? So somebody does something, there's a big scandal, and then all of a sudden there's some laws that are put in place, and then somebody figures out how to beat those. And so it's just a constant, just this constant cat and mouse game going back and forth. And so I thought it would just be interesting because you have to understand stock market history, some of these scandals, how they have impacted different companies and just the market in general, so that when you're doing your studies, you can figure out a way to kind of implement that. So the first one that we're going to go over is Enron. And so Enron was one that actually happened when I was in college. I remember going to watch the Houston Astros at Enron Ballpark there in Houston. So Enron was located in Houston, Texas. They were a kind of oil and gas, well, not oil and gas, but mainly energy company. They had come up with kind of a new way. It's always scary, right? We have a new way of doing accounting. And they became one of the biggest companies in the world. Absolutely became one of the biggest companies in the world. Their stock peaked around $90 a share, and it had one of the most dramatic falls ever. Went from $90 a share to zero in the span of about, let's call it 18 months. But it was a pretty dramatic fall, and it was one of the top 10 Fortune 500 companies in the world when it, kind of at their peak. And so what Enron did was they created a bunch of fake companies shell companies, and they would basically send these invoices to these other companies and recognize that revenue from the different companies and basically just pass it around, right? So we're doing revenue with this company, and then that company bills another company. And so that business never really happened. And it went on and on and on. And what made Enron so deadly is that their accounting firm, Arthur Andersen, was in on it with them. Excuse me. Arthur Andersen, their accounting firm, was in on it with them. So when they were doing the audits, they were signing off on it. And, you can't even imagine what a no-no that is. But when you have an auditor that's signing off on your bad books, this is what a term referred to as cooking the books. That is where people really, really get hurt. And so when you look at some of the stats on this, and you can go to YouTube, and if you're listening like at home, just kind of Google Enron stock chart and just look at what happened to Enron stock chart when the kind of people started questioning their financials, and they started asking them very detailed questions because financial analysts were having trouble deciphering what was going on here. And you'll see how fast the decline was. But when you look at Enron, some of the worst things that were so bad about it, and I encourage you to go watch. There's a documentary, I'm sure it's on YouTube, called "The Smartest Guys in the Room," and it's a documentary on the what happened with Enron. You can see people wearing a bunch of bad '90s clothes, so that's kind of fun. But you really get to see how horrible the executives treated the people who worked for the company as well. And the complete, just utter, just not caring about people in general, the customers, when they were having blackouts in California that Enron was causing. But one of the things that was so bad is that the executives were selling shares of stock while they told employees to buy it. And so there's video of them in employee meetings discussing, buy our shares while the executives are sitting there selling as many shares as they possibly can. And so that would be Jeffrey Skilling, Kenneth Lay, they were the CEO, president. I don't know what their exact titles were, but they were sitting there telling their employees that, hey, you got to buy, our stock's going to do great. And they're leaving those meetings and they go and sell as much stock as possible. And so some of the laws that have been changed by this are the Sarbanes-Oxley, say that 5 times fast. Sarbanes-Oxley was created for independent financial auditors, because when they found out that Arthur Andersen was in on it, obviously Arthur Andersen was one of the, right now we have the big 4 accounting firms. It used to be the big 5 accounting firms, and Arthur Andersen went under because of it. But one of the truly tragic legacies of Enron was the fact that most of the employees that worked for Enron had the majority of their retirement, their 401ks, invested in the company. And so when this started happening where Enron went bankrupt, it locked the employees out from being able to sell their shares. So some of the employees that had worked for Enron for 15, 20 years and had all of their 401k invested in Enron stock, they went broke and their retirement was gone. So they lost their jobs, they lost their retirement. And that's why today, if you work for a public company, you're only allowed to put so much of your 401k into the company that you work for. Because if something happens and the company you work for is doing something like this, you don't lose your retirement and your paycheck all at the same time, which is what happened to Enron. And so, if you go watch Smartest Guys in the Room, that's part of probably the main takeaway is how devastated some of these employees were, because some of them had worked for Enron for 20 years. They were close to retirement. They lost everything and they didn't have time to put it back together. And so Just a really tragic situation for those people. But that's the reason today that you can't load your 401k up with the company stock of who you work for, which is an important distinction for all the people that have come behind that. One final thing on the Enron scandal, and from a public standpoint, what really bothered many people was the fact that the way corporations are built is that it shields executives from personal liability. And so there was a big public outcry to be able to go after the executives who had done this. And so it took a while, but Ken Lay ended up going to jail. Jeffrey Skilling went to jail. The CFO, Andrew Fastow, went to jail. And so this really changed laws on being able to hold executives accountable for doing things like this inside companies. And, there's arguments on both sides that it isn't enough, that people should be able to, executives should be able to be held more accountable. But, there are new laws in place that allow this to happen. I think Jeffrey Skilling was fined $45 million for this, basically what his net worth was at the time, to try to take that away and to recoup some of that money. But even after they recouped the money for the employees, it still wasn't enough to go around. And so this happened, 2000, 2001. And you have to remember that the tech bubble burst in the year of, March of 2000. And so there's a lot of pain in the market going on. And so when you have that kind of pain, it really starts to, when you're doing these kind of things, it starts to expose you. So soon after Enron, there was WorldCom in 2002, and then Tyco International in 2002. Because when they passed Sarbanes-Oxley, you started having these independent auditors where WorldCom was taking their operating expenses. So operating expenses are things like, like if you go buy supplies, pens, pencils, paper, copy paper, that would be considered an expense for your business, right? Well, they were booking those expenses as investments. And not the right place, not the right category. They had done it like year after year for a total of $3.8 billion. So that $3.8 billion that should have been an expense was actually an investment on their balance sheet. And so that ended up, I think that stock went from $60 to less than $1. I mean, anytime you have accounting irregularities, it's one of the only things where I basically, if I invest in a company, I will sell the stock and ask questions later, because accounting irregularities are just such a no-no. If you can't trust the numbers that you're looking at, then how can you invest in the company and trust the management team? Right? Because when you're an investor in the business. And so if you have a management team that's doing something they shouldn't, how can you take any of the other numbers seriously? And it is a very serious offense, because the United States has some of the strongest accounting laws in the world. And so there's a lot of investors from around the world that invest in the United States because they think that they can trust the numbers. And so when you have companies that breach that becomes a major issue. So if I see accounting irregularities, I will sell questions, or I will sell the stock and ask questions later. And it's one of the, when you're looking at international investing, if you look at like investing in China, that's one of the drawbacks of investing in Chinese companies right now, is that investors don't know if they can trust the numbers. And so if you can't trust the numbers, then it makes it really hard to invest for the long term in a company. The other one was Tyco International, same year, 2002. Their CFO received tons of money. They were issuing stock that they would issue stock, but it was for themselves. It was for the executives. And so then they would basically give it to themselves as a bonus. And they were using that money not to help the company, but to help their lifestyle, I guess. Can't be a baller on a budget. And so they would use those funds. There was a $6,000 shower curtain one of them bought, $2 million birthday party for one of their wives, houses all over the world, that kind of stuff. And then when that came out, their stock price dropped 80% over 6 weeks. And the executives actually went to jail for 25 years on that. So as we see past Enron, some of these executives are being held accountable for the first time for doing these just crazy things with these companies. So next I want to discuss Bernie Madoff, which happened in 2008. But before we do that, we got to talk about the financial crisis of 2008 and kind of how that transpired. So you have the dot-com bubble bursting in 2000. The market starts to, and then you have these scandals I just talked about, Enron, WorldCom, Tyco. The market starts to recover, and then all of a sudden we have 9/11. And so when 9/11 happened, that's when the Federal Reserve started lowering interest rates, trying to spur economic development, right? So when the Fed lowers interest rates, they're trying to tell you, hey, go out and borrow some money. We'll make money cheap, build that house, go on that vacation, buy that car. And so they lowered the federal funds rate, right? The interest rate from 6.5% to 1%. And so when they did that, there's a lot of people who started refinancing their homes. They started trying to buy bigger homes. And there was always this case that this is where we always get in trouble. Over the last 80 years, home prices have never gone down. And so they just start to, you start having easy money. Everybody's able to borrow as much money as they need to buy a house. And so, you start having this easy money, which starts fueling this financial bubble as far as housing is concerned. And so I wasn't, I don't know what word to use here, astute at the time. But when I started doing financial planning, investing for people, I remember being in Dallas in around 2006, and I went to a big house in one of a very nice Dallas suburb. I walk in and the people have lawn furniture. And I was like, why? And then I started looking at their financials where all their money was going to their house payment. And I had a gentleman who wanted to kind of do referrals, and he was a mortgage guy. And I said, why are y'all making these referrals to people who can't afford these houses? And he goes, well, if I don't give them the money, somebody else will, so I might as well do it. And that was the first time I thought, oh, that's not a good sign. But I just didn't realize it was happening everywhere. And so, I remember the first house I bought, I didn't put any money down, no money down. And so all these financial institutions were giving money away. People weren't having to put money down on homes. So that means they didn't have any skin in the game. And you start having these subprime borrowers, which subprime means it's somebody who maybe has bad credit. You're not sure if they're going to be able to pay you back. And then you had mortgage companies that were selling the mortgage, meaning they would write the mortgage and then they would immediately sell it to somebody else so it doesn't become their problem, right? So think about if you go to buy your house, and if any of y'all have done, if you've bought a house, you've probably noticed somebody writes it, and then 3 months later, you get a notice in the mail that they sold it, right? So they're not going to service your loan for the next 30 years. And so these companies were doing mortgages for people who couldn't really afford them, but they didn't care because they were just going to sell it to somebody else. And so you have that happen over a number of years, trillions upon trillions of dollars. And then all of a sudden Americans were in homes. The housing bubble burst, house prices fell. People are in homes that are now worth way less than they owe. So maybe the house is worth $1 million, but they owe $1 million on a home and it's only worth $600,000. So people just started moving out in the middle of the night because they didn't have any money in the house anyways. And so it just started cascading. Well, market, that one was definitely, I think, scarier than what's going on today. But you have this massive drawdown you have in the stock market, and that's what exposes Bernie Madoff, right? So Bernie Madoff was running a Ponzi scheme, which means that you basically are paying your first investors with money from new investors. So for instance, this is so kind of interesting, so funny to me. So Bernie Madoff had a huge Ponzi scheme where he had a hedge fund that was consistently making 11% a year, every year for 15 years. So right there, you should have alarm bells going off. It's basically mathematically impossible to have 11% returns every year for 15 years. Like, impossible to be able to do that, especially during the tech bubble bursting, all the bad stuff that I just mentioned. Being able to do that kind of performance is in and of itself. So what he would do is he was gathering, new clients, and he would make sure the first clients made their 11% every single year, which Ponzi schemes, by the way, are not bad if you're first. They're just really bad if you're last. And so, but when the 2008 financial crisis happened and the market has its worst year ever, right? A really bad year. He can no longer hold this thing up because he would look at the paper every single day and he would basically back into the returns that he needed so he could make it look legit on paper. So if you go to Audible download the Audible app, there is a podcast that they did called Ponzi Supernova. And it's a short, 8-episode documentary on Bernie Madoff. He was sentenced to 150 years in prison. He actually died behind bars a year ago. One of his sons committed suicide after he found out. He was actually turned in by his sons. But in that Ponzi Supernova, they actually do interviews with him from prison before he passed away, and it is very interesting. I think the most shocking thing about that one for me is that if he would have put in some bad years instead of doing 11% every single year for 15 years, if he would have put in some bad years, like -3 this year, +3, put some average years in there. I don't know how he would have ever gotten caught. And in my office, maybe I'll post a picture of this on Instagram. I have some Bernie Madoff trade confirmations that he did in 2008, where a trade confirmation is he would sell stock for somebody, and then they mail you a trade confirmation saying that the trade happened. And the thing looks so real. I can't imagine how hard it would be to fake this for so many years and how exhausting that must have been. But just and Ponzi schemes are happening all the time. You just don't hear about them because Bernie Madoff's reached $50 billion. And that is a scale that has not been the largest one in history, as far as I know. And so that really becomes, obviously there's a lot of people that were impacted by that, but there are Ponzi schemes that happen all the time. I get securities information, emails that show ones that have been caught and found, and usually they don't make it to this scale. But Bernie Madoff was president of the NASDAQ, or the chair of the NASDAQ for a while. He had a lot of SEC Securities and Exchange Commission audits where they actually didn't find what he was doing. It was just almost perfect timing, but that was definitely one that you will hear about, and one that's important, because I think what worries me about that one is I think that there could be somebody that's doing that today and just hasn't been caught yet. So I think as an investor, it's important to know that there are always going to be scandals, company scandals going on around you. And it's kind of part of doing this. But even today, I thought this would be something interesting to talk about, because even today we have all this stuff with the crypto companies, right? And you have Three Arrows Capital, and every day there's a report on them going bankrupt. The founders of that are in hiding because they're receiving death threats. The federal judge just locked up all their assets, and they owed a lot of other companies money. And so now those companies are having trouble paying the people that they owe. And that's kind of how these things start, right? So just like with the financial crisis, and you had one company owing another company money, it just starts the domino. And so with crypto, though, there hasn't been regulation. there were some crypto companies that were paying people 20 to 40% interest. I mean, really? I mean, when everybody else is making nothing in their savings account, you're going to be able to pay me 20 to 40% interest. How's that possible? I mean, as an investor, you have to be smart enough to know, okay, that seems way too good to be true. And so you look at that, and that's just, as we see this play out with crypto going from being worth 3 trillion to 1 trillion, you are going to see some pain in that department. There are going to be more and more stories of companies that are in trouble or that just disappear forever. I mean, even 3 days ago, Uber, the ride-sharing platform, I mean, there are all kinds of stuff coming out on Uber on how this one I'm looking at, massive leak reveals how top politicians secretly helped Uber. And so, I mean, there's actually a website called uberscandals.org. I mean, if you're a company and there's a website that has your name with scandals behind it, .org, that is not a good place to be, talking about how they violated city rules, licensing, invaded privacy, sexual harassment. I mean, all of these things. I mean, it's, not every company's public, but, companies are going to go through issues, but when it just keeps happening over and over again, you wonder if it's a cultural issue. Politicians helping Uber probably get contracts. There's probably some kickbacks that we're going to find out about. So, crypto, all of these companies, I mean, you just have to protect yourself as an investor. And this is why, thinking about the risk that you're taking when you invest in a company, making sure you don't put too much of your money into a company. You have to really start thinking about it when you start having more than 10% of your portfolio value in one company. This is why right-sizing your position and making sure that if something were to happen, you'd be able to handle it, unlike many of the Enron employees. So this is just a word of caution that, to protect yourself, because a lot of times these companies that we put so much faith in, we can't always be guaranteed that they're going to do the right thing for their employees, their investors. It's not that people are against you. It's just that they're for themselves. And so sometimes you get some greedy executives or management teams in there that make poor decisions. And, it's a slippery slope for sure. So anyways, I hope this was helpful for you. I thought it was kind of fun to cover this. We'll look at finding some more in the future. But as always, I appreciate you taking the time to listen. Have a great week, and I'll see you next time.